Pankaj Tibriwal, as well as Dhirendra Kumar from Value Research as well. Pankaj, hi, morning. Good to have you on the show. Let's begin the discussion with you. Has time now come that the market re-rating has happened and one should bet on the small cap and mid caps after a long bout of underperformance which has lasted almost over a year now?
Good morning, Nikunj. Good morning, Aisha. I think the big event of elections is out of the way, and with the political mandate, clearly it's a great source of comfort for the markets, with policy predictability being expected down the line. I think the underperformance of mid and small cap segment versus large cap is quite huge. In fact, it's at historical extremes. If you look at the small cap index, anywhere between 16 to 18% it's down in 1 year, where Nifty is up about 11 to 12%. So there's a clear 26-27% gap. Even in mid caps, you see that gap about 16 to 17%. Our analysis suggests that anytime when mid and small cap underperform on a rolling return basis by more than 15%, the next 12 to 18 months is quite strong for this segment. Also, if you look at the difference between the broader market and the narrow indices, I think it's fairly large. And I think from here on, we believe that the returns from Nifty could be moderate and broader markets could outperform Nifty going forward.
Kotak large cap scheme and a mid cap scheme. Are you telling me that I should sell my large cap scheme and buy a mid cap scheme?
So what we are advising investors every time, even in the bull run of mid and small caps, that don't get carried away. Have a disciplined asset allocation based on your risk appetite. To a 65, 70-year-old, definitely you can't have mid caps as a only source of fund deployment. Whereas a young guy also, we won't say that go 100% into mid and small cap. What we are saying is that 60-40 between multi-cap and mid and small cap should be your allocation. And if you have a slightly higher risk appetite, you can maybe move to 50-50 or 60-40 the other way around. So obviously you need to maintain your disciplined asset allocation. You need not get carried away by either sides, whether it be large cap, multi cap or mid cap and small cap.
Sure. Let's get Dhirendra Kumar in as well on this discussion. Dhirendra, same question to you, and really to get your perspective on whether this is really the right time now to seriously start looking once again at some of the mid-cap, small-cap funds.
Yes. In fact, small cap, mid caps are not suited for or are not meant for all kind of investors. But these are always the best time. In fact, investors tend to do the other way around. Investors always are very excited after they have done very well. If you look at the flows in small and mid caps, it's always after the story is over or it is getting close to being over. And in times like this, investors are anxious. They are only waiting to pull out. But for any investor, if you look, and the graphic which we are showing here at the outset, which is -6, returns ranging between -6 to -10% over the last 1 year. And 150% to 100. The worst fund has actually given a return of 20% annualized, 100% absolute, 100% absolute over the last 5 years. That's quite phenomenal. That itself reflects that what to expect from these. And even if you look at long-term returns, the small caps and the mid caps and the large caps, the returns converge in a range of they are able to outperform by 1 or 2%. So I would say that for investors to optimize their own return, they should have a very defined allocation to mid and small cap. It is not meant for all kind of investors, and investors must be regular with it because the kind of free fall which we see in mid and small cap, it gets extremely difficult for investors, even investors with a very strong stomach, to withstand the carnage.
Pankaj, whereas one large call is asset allocation. We all know that stick to your asset allocation, know your risk. So there's nothing new about it. But what we're trying to understand, Pankaj, over the course of next 4 or 5 minutes with you and Dhirendra is that does it make sense now to put that extra 10% exposure to mid and small cap stocks provided where the levels are? 2018, it made perfect sense to start redeeming out of mid and small cap stocks. We can say that in hindsight, okay, we can always say 6/6 in hindsight was great. But today, if you have to stick your neck out and advocate that, look, it's time to increase 10-15% more allocation to mid cap stocks, would you like to do that, Pankaj?
Absolutely, Nikunja. I think this is the time where you have a stable government in place for the next 5 years. And our view is that the innings which this government can play could be very different from the first innings they played. It could be more growth oriented. It could be more domestic centric, focus more on manufacturing and infra, focus more on agri side. So I think this is a classic bottom up market. We would believe that there are a lot of quality companies in each and every sector. Let me give you a few examples. Look at what has happened on the specialty chemical segment. It's completely dominated by mid-cap companies, whereas we may argue that in the last 18 months, mid and small cap segments have done very badly, but this is one segment which is at all-time lifetime high. Look at what cement is going through. After a long time, the pricing discipline is back. People are not chasing market share, and a lot of companies dominated in this sector are represented by mid and small cap companies, and probably they are also at lifetime highs. Look at corporate banks in the financial space, dominated either by large caps or mid caps. They are doing exceedingly well. So I believe it won't be the same broad wave which we saw in 2017, where the tiniest of the company gave you the maximum return. I think people will like to stick to quality in mid caps, and there are ample opportunities in different sectors. What we need to do as investment managers is go and pick up on a bottom up basis where we believe earnings for the next couple of years could be very strong. And as the tail in every sector weeds out because of various issues in the environment, liquidity, I think the market share shift could be very swift for a large number of companies in each of these sectors. And I believe India is still dominated by good quality mid-cap companies. Their managements are very, very able. And companies which have been able to survive this downturn, I think over the next 5-7 years, they'll become quite large. They themselves won't believe in the sense the market share shift which has happened. One small example which I would like to give is look at the tile manufacturing companies. What happened 2 months back in Morbi from the NGT order on pollution is unprecedented. Out of 800 units functioning there, 400 units had to close down, 200 units restarted, but 200 units are permanently closed because they were working on coal. And if you need to work on gas, you need to do everything in black and white, and GST authorities are there over your head. So I think clearly that market share gains would be felt by a lot of companies in many sectors, and we are excited that in many sectors we are seeing ample opportunities in the mid and small cap space.
Right. Dhirendra, you've traditionally never been a fan of taking concentrated bets. So, irrespective of the market wave now seem to be, turning bullish when it comes to the broader caps, would you still say keep it balanced? Investment in small and mid caps doesn't mean that you omit your large cap exposure?
It is small cap funds or mid cap funds are not meant for all investors. Only investors, two set of investors should actually be investing, and with a different orientation. Investors who have 5 years of regular investing temperament should only invest, and investors who have experienced the market, because anybody who starts new and starts with a small cap, mid cap, which most investors did in 2017, because every investor is chasing recent past performance. So it is extremely disappointing to begin with. Small, and also I would like to say that timing instinct one should overcome. So one is that it is not meant for all investors. Only few investors who have that long-term orientation, as well as have experienced what kind of downside there is, and they are used to it and they can withstand that. It's meant for that. I would like to give you an interesting
Just before you continue, with that, I guess the question here is also that a lot of these mid caps and small caps are already incredibly beaten down. So if one's getting into some of these funds at a time like this, the question is then, is there a near-term upside, even if that near-term is 2 to 3 years from now? You know, given where we're currently trading at, you know, would you still anticipate the kind of volatility that you've been talking about that perhaps investors have seen in the past?
You know, the jury is still out. I agree with Pankaj that there could be outliers, there could be sectors, there could be specific companies, but the mid-cap and small-cap universe is very large. If you look at the SEBI classification, you have thousands of companies to choose from, and you can virtually, you know, you can almost go anywhere. You know, there is another viewpoint to this story that, you know, I was talking to a fund manager who is managing a large amount of money, perhaps the biggest individual asset manager, and he said that, you know, the mid-cap carnage has just started. The train has started from Bombay for Delhi, and it has just reached Ratlam so far. It has long way to go on the downside. So I don't know. There will be all kind of viewpoints. There will be outliers, but small and mid caps are not meant for big bets by individual investors. It's not meant for everybody.
You're doing the guesswork, Dhirendra, on which fund manager you met amongst the two names that we can think of. But anyway, Dhirendra, any recommendations then when it comes to small and mid-cap funds? Any 3 top names?
There's plenty to choose from. In fact, when it comes to, you know, somebody taking a very opportunistic bet here, I would say that the most beaten down tend to be, because, you know, we see the reversion to mean. The people, you know, we see the degree of cyclicality. The ones which are, you know, I still like the Sundaram Smile Fund, which is nowhere on the rank. And we keep getting such surprises on in these two categories. Because when we look at the large cap or the multi cap or the large fund, which is a multi cap fund, they tend to look alike. But here is a fund where, you know, every fund manager looks different, and they succeed with their different strategies. We don't see the commonality here. So I would say that even consider the ones which are not, you know, the top rated funds and beaten down ones.
Dhirendra?
Yep.
Dhirendra, any names that you can think of when it comes to these funds, even though they may not be top rated, you're saying?
Look at the worst one, you know, which had a great time as well, the Birla Sun Life small cap. Looking for a quality one, Axis small cap. And you know, the one which has turned big, and it is trying hard to remain a small cap fund, a compelling performance, and the most consistent, Franklin India smaller company.
Thank you for those names, Pankaj. See, if you have to put a 5-year window, what do you think should be not a promised return, but a expected or a projected return if somebody starts in a large cap fund today and a mid cap fund today?
So, I mean, going by history, as Dhirendra also mentioned, many mid-cap funds and small-cap funds have given a 18 to 20% annualized return still after the carnage in the mid and small-cap segment. If you look at the large-cap one during the same period, it's about 14 to 15%. So, in our view, I think 3 to 5 percentage points on a category average should be a decent outperformance over large caps one should expect over a longer period of time. Similarly, if you look at a 10-year period, I mean, we were coming out of a low base in 2008-9, but the returns look quite similar, about 19 to 20% annualized return in this category. So I think a decent number would be 4 to 5% outperformance over large caps over a 5 to 10 year period. I think, but there's no sacrosanct, we are just going by numbers in the history. But I believe that in the next 4-5 years, the importance in this segment, which I have learned over last many years, is to avoid mistakes. I think most of the people run after finding the new multi-bagger, but in this segment, if you can avoid losers, winners will take care of themselves automatically. So you don't have to go and hunt for multi-baggers every day. You have to stand on the pitch so that your wicket, you can handle it well. And when the full toss comes, you need to hit it out of the park. So this segment, one needs to take it from an investment side more on a consistent basis rather than every day trying to go out and find multi-baggers.
Last purchase been? I mean, where have you found the last full toss?
Clearly, look at the cement and the specialty chemical segment. Clear indications were coming that when we were speaking to most of the agrochemical guys, globally they were dependent on China. Environmental norms were getting stricter and tighter, and you saw that a small shift of supply chain from China to India has created a huge visibility for a lot of specialty chemical companies. Look at cement. Again, you had a situation where supply over the next 3 to 5 years will be lower than the demand in our forecast, which was not the case 5 years back. And the leader is now a little more price disciplined. You are seeing that people are not chasing market share, and that was a sitter till 3-4 months back, where cement companies were trading at ridiculous valuations. And in our view, over the next 3 to 4 quarters, you will see strong earnings growth coming in this segment. Look at the corporate banks. I think clearly the big wave of NPA cycle is behind us. I'm not saying that we are over with the fragile environment. NBFC still continues to be in a problem area, and we need to monitor it very closely. But the large private sector corporate lenders are gaining disproportionately out of this environment. Pricing power is back with the banks after a very, very long time. So this was another area. Consumption we had cut down very aggressively over the last 6-8 months. In some of the funds we had auto, which is zero exposure, and clear the signs that probably you could see certain parts of consumption basket slowing down. Another bet which we are taking now is that probably capital goods could be, and infra could be, one segment which has not performed for the last almost 10 years, a decade, and you could see mean reversion happening there. The commentary coming out of most of the capital good companies is quite encouraging, and we believe this segment should be watched out for.
All right, gentlemen, thanks so much for joining us and on that discussion today. Good to have you both with us.